Okay, let's dive into this. Investing, it often feels like this secret club, right? Something reserved for Wall Street wizards in fancy suits. But what if I told you the real secret wasn't about being a genius stock picker, but was actually just about not making a few really common mistakes? Well, in this explainer, we're going to break down a super simple, proven method that makes building wealth surprisingly easy. For real. And this quote, man, it just nails it, doesn't it? So many people look at the stock market and all they see is a giant casino. Fortunes are made, fortunes are lost, all based on some random ticker symbol instead of a playing card. We see somebody hit it big and we call them a genius. But here's the real question. Was it skill or was it just one lucky spin of the wheel?
And that's the core difference right there. See, in a casino, the house always has an edge. The odds are literally mathematically stacked against you. Sure, you could bet your entire life savings on green at the roulette table and win, but that doesn't make you a skilled gambler, it makes you a lucky one. And trying to do that again and again, that's just a recipe for going broke. Real investing is the complete opposite. It's a long-term game where you can actually put the mathematical odds in your favor.
So, if we want to win, where do we start? Where do we learn the rules of the game? Well, and this is going to sound a little weird, the best lessons don't actually come from the so-called winners, they come from the people who lose and lose spectacularly. Seriously, understanding why people fail is the absolute key to learning how to succeed.
This is it. This is the fundamental mistake. The bad investor isn't crunching numbers or looking at spreadsheets. Nope. They're running on pure hype, fear, and this desperate hope for a quick payday. They hear about some stock that's going to the moon and they jump in, absolutely terrified of missing out, but they have no real strategy. Every single decision is based on emotion, not math.
And here's how that tragic journey usually plays out. I know it might sound like a joke, but this is a depressingly common story. You go all in on these super risky bets, you lose big, and then, in a total panic, you risk the little you have left trying to claw it all back. It's this vicious cycle, fueled by panic and regret, that almost always ends in the exact same place, a big, fat zero.
Okay, enough about losing. Let's talk about how to win. And the hero of our story, believe it or not, isn't some flashy Wall Street trader. It's a guy named John C. Bogle. He founded a company called Vanguard, and he championed a brilliantly boring method that has, time and time again, wiped the floor with most of those emotional gamblers. Bogle was a really rare character in finance. He was a genuine good guy. He actually set up his company, Vanguard, so that its profits went back to the investors themselves, not into his own pocket. He was completely obsessed with cutting fees, and it's estimated he saved regular people like you and me $1 trillion. His personal net worth was just a fraction of what it could have been, all because he decided to put the investor first. And his whole philosophy, that's the key to this entire strategy.
Now, to really get Bogle's method, we have to talk about risk for a second. A lot of people think investing is all about avoiding risk, but that's not quite right. The secret isn't avoiding risk. It's understanding which risks are actually worth taking. You want to take the risks where you get paid for taking them, the ones that are compensated with a higher expected return.
And let's be super clear about what risk even means here. It's not just about the chance of losing money. Think of it more as the range of possible outcomes. A low-risk investment is super predictable, but a high-risk investment, whoa, it could give you a huge gain, or it could totally wipe you out. The spread of what could happen is just much, much wider.
And this is the other half of that equation, expected return. Think of it as the long-term average. If something has a 10% expected return, that doesn't mean you're gonna get 10% next year. No way. You might get 25% one year and then lose 15% the next. But over many, many, many years, the average should start to look a lot like that 10% number.
So, why bother taking any risk at all? Why not just keep your money in cash? Well, because of this silent killer of wealth, inflation. If you just let your money sit there, it has a 0% return. Meanwhile, inflation is making everything you buy more and more expensive every single day. Your money is guaranteed to be worth less next year than it is today. That $50 burrito is a perfect, if terrifying, example. See, not investing isn't playing it safe. It's locking in a guaranteed loss.
This chart shows you exactly how it all works. To just beat inflation, you need a higher return than cash can give you. You can get that with bonds, which are a little bit riskier but offer a better return. But if you want the highest expected return, you have to look to stocks. Over the long run, owning the entire US stock market has returned about 10% a year. Yeah, it's riskier in the short term, but you're compensated for that risk with a much higher average return over time.
Okay, so that's the why. But how do we actually do it? How do we capture that sweet, sweet stock market return without gambling on individual companies? Well, the answer is a simple, beautiful blueprint that Bogle himself championed.
It's so simple, it's brilliant. Instead of trying to find the needle in the haystack, the one winning stock, you just buy the whole haystack. A total market index fund like Vanguard's VTI lets you do exactly that. With one single purchase, you own a tiny piece of over 3,500 different U.S. companies. You're no longer betting on one horse. You're betting on the entire race.
And the way these funds are built is just genius. They're what's called market cap weighted, which is just a fancy way of saying that the biggest companies make up the biggest slices of the fund. What this means is your money automatically goes towards the current winners, like Nvidia and Apple, but you also still own thousands of smaller companies, just waiting to capture their growth if they take off. It all happens automatically.
And boom, here it is, the complete blueprint. To be really, truly diversified, you don't just want to own the US market. So you add an international fund to own companies all across the globe. Then you add a bond fund. Think of bonds as the stabilizer, the shock absorber for your portfolio. When stocks take a nosedive, bonds often hold steady or even go up, which protects you from the worst of the swings. This simple three-fund combo, that's the whole shebang.
One final, absolutely critical point, and this is straight from John Bogle's playbook, fees. You have to watch the fees. They always look so small, right? Like less than 1%. But they compound over time and can literally devour a massive chunk of your returns. So always choose funds with the lowest possible expense ratio. This part is totally non-negotiable.
So we've covered the why and the how. And now, it really just comes down to a simple choice. There are two paths you can take with your money, two characters you can choose to be on this adventure.
Over on the left, you've got the day trader. This person is glued to their screen, totally driven by emotion, constantly trying to outsmart the entire market. It's stressful, it's exhausting, and for pretty much everyone, it's a losing game. Then, on the right, you have the long-term investor. They set up their simple portfolio, they keep adding to it, and then they go live their life. And the hilarious irony is that by doing almost nothing, they end up outperforming 99% of those frantic traders.
Look, we can't predict what a single stock will do tomorrow. We can't even predict what the whole market will do next year. But what we can predict with a very, very high degree of certainty is the long-term outcome of these two approaches. One path leads to stress and, for most people, failure. The other path leads to quietly, consistently, and calmly building real wealth. So the only question left is, who do you want to be?